Hello, everybody. Hope you are having a stellar Thursday. My name is Kinsey Grant Baker from Barchart, and I'm excited for the interview we've got lined up today. I personally am planning on taking a lot of notes. I bet you will be joining me in doing just that, and you're probably wondering why. That is because today's conversation is really going to be centered around protecting your gains in a turbulent macroeconomic environment, which is sort of the key theme for 2025 so far. I mean, any given day can represent a major tide shift in the macro reality, and that can significantly impact your investments, your investment strategy. So how do you protect your portfolio? How do you build in a buffer to ensure that you're maximizing your gains, minimizing your losses? And how should you think about things like tariffs and trade policy and inflation and a whole lot more in the real world? Today, we are going to cover all of that. I'm really excited to welcome two fantastic guests to help us get a feel for all of this that I have just mentioned. We have Andrew Nelson, Director of Product Strategy at Innovator ETFs, and Tim Urbanowicz, Chief Investment Strategist at Innovator ETFs. These two are going to walk us through Innovator's approach to protecting your portfolio from, taking more of a defensive investment strategy to hedging against what I think we could fairly call macro whiplash. And Innovator knows their stuff. They're, the big player in buffer ETFs, which are essentially designed to give investors protection against losses while still being able to tap into upside. Innovator currently manages approximately $24 billion in ETF assets under management. So I'll let Andrew and Tim tell you a little bit more about their work and what they're doing. But I'm excited to hear their perspectives today. Andrew, Tim, welcome to our conversation. How are you?
Hey, Kinsey, thanks for having us. We're good.
Excited. Amazing. Yeah, I'm excited to talk today. I think anybody who has attempted to keep up with the news and with anything that is coming out of the White House and whether it's hitting Twitter or wherever you're finding it, it's a lot. There's kind of been a lot of velocity in terms of news and headlines that investors might find important or impactful. So I want to start today with a little bit of a bigger picture question. Like I was mentioning, it's kind of been what I would say is the textbook definition of a whirlwind of a month, maybe a couple months for tariffs, for trade policy in the US under this new Trump administration. Tariffs on Mexico, Canada, China. First they were on, then they were off, then they were delayed, then they might be doubled, then they might not. Just this week, steel and aluminum tariffs went into effect on Wednesday, yesterday, and Canada put a 25% retaliatory levy on more than $20 billion of US goods. Bottom line, there's just a lot to track. There's a lot to keep track of here. Uncertainty really seems to be the norm again. So I would love to hear your perspective at the high level. Tim, can you explain a little bit more about what macro headlines investors should really be paying close attention to right now?
Yeah, Kinsey, and I think you hit them all on the head. And, we work with advisors every day, and I feel like the question that we're getting every single day is really, what is the net impact of Trump 2.0? You put this all together, whether it be, the potential for tax cuts, deregulation, tariffs, Department of Government Efficiency. What does it all mean? What's the end impact going to be for our portfolios? And I think a lot of investors are confused right now. And you look at the 2016 to 2020 run with Trump. Almost every day it felt like he was touting the stock market. It was almost his evaluation of how he was performing. Oh, highest stock market. I think he even had one post where he said, any sitting president where the Dow drops 1,000 points in a day should be shot in a cannon to the moon or something of that sort, right? So it's entertaining. And then this time what you'll notice is completely different. He hasn't mentioned the market once. It's kind of like, oh yeah, they're going to see some volatility, but at the end of the day, we put it all together. I think it's very, very clear that he is going for short-term pain for long-term gain. And I think the name of the game for investors right now is you have to prepare your portfolios for a wide range of outcomes. And specifically, I want to talk about both DOGE and tariffs, but tariffs specifically. Incredible amount of uncertainty here. These are something that could be very minimal, or they could be catastrophic depending on how they are implemented. And and even just taking a step back, you look at what is a tariff? That you heard all these different strategists or economists talking about. Oh, we think it's going to impact inflation. It's going to send prices higher. We don't think that at all. Tariffs are something that are a tax. Okay, they're a one-time. It's a tax that is going to give us a one-time increase in prices. And at the end of the day, what that does is it is going to put additional pressure on consumers. Now, is that coming at a good time? No, it's not coming at a good time. This is not 2017 where we basically had zero inflation. Consumers are doing very well. That we're at a time where a lot of consumers, specifically, you look at that lower end of the spectrum. Think about your blue collar worker. Maybe making 50, 70, $60,000 a year, struggling to buy their everyday necessities. They're already it's hard. Okay, so you put these price increases on. It adds a lot of pressure at a very inopportune time. It could be the straw that breaks the camel's back when it comes to the consumer. Now, I think you look overall just to kind of put the impact in perspective. We don't know what the end impact is going to be because you don't know how they're going to be implemented. Is it going to be this 25-20 when you look at Canada, Mexico, and China? Potentially, but you have to also keep in the back of your head that Trump is using this as a negotiating tactic. So you could look up 5 minutes from now and we could see this market ripping higher because he's pulled these some of these tariffs off or down. But I think it's also helpful to look at it from the perspective of, what if they are implemented at full scale as is, meaning, 25% on Canada, 25% on Mexico, 20% on China. You put all of that together, you look at, what are the imports from these countries look like? Combined, Canada, Mexico, China account for about 5% of total US GDP. Those imports account for about 5% of total US GDP. So not huge, but it's also not small. Okay. About 1.5% from Mexico, 1.5% from Canada, and the rest from China. So it is going to have an impact. The estimates that we're looking at right now, probably about a 1% hit to GDP in the U.S. So not recessionary necessarily in nature, but also not exactly the most conducive environment for growth, especially not when we have a situation where inflation's still running at 3%. And so there is going to be some impact in the U.S., but I think more so if you look at Mexico and Canada, and this is where I think Trump is probably in the driver's seat when it comes to these tariffs, is you're talking about a catastrophic hit to both of those economies. These imports make up about 20% of Canadian GDP, about 27% of Mexico's GDP. So you're looking at about a 5% and an 8% hit to those GDPs respectively. That puts both of those economies into a recession. Not exactly ideal. So huge degree of uncertainty when it comes to these. I don't think it's something that you can just go out there and prepare for and say, yeah, it's going to impact the market this. It's all about preparing your portfolios for a wide range of outcomes when it comes to these tariffs.
Yeah, absolutely. And Tim, I appreciate the amount of context that you included with all this. I think that it is certainly a point well taken that the idea that there could be a change in the next 5 minutes or the next 5 weeks or the next 5 months about how this impacts the everyday investor and just the everyday consumer as well. It's something that I'm sure a lot of people listening to this are certainly thinking about often. I want to zero in specifically a little bit more on the inflation element of this. Consumer price index rose 2.8% annually in February. It's a deceleration from January's numbers. And of course, there is the DOGE of it all when we're talking about inflation that I think is an important part of the conversation, certainly. Attempting to trim costs regardless of how likely or unlikely, $2 trillion in spending cuts really is. I would love to hear a little bit more about how investors can kind of put this into context for their own strategies. We're talking about uncertainty as just something that we have to get used to as investors, really regardless of who's in the White House. But for this administration specifically, I would love to hear a little bit more about what you expect in terms of inflation moving forward. What's kind of on your radar right now? And I'm going to also pull up some slides too that you guys can.
Absolutely. And actually, Kinsey, can we go to the next one first? I want to come back to this in just a second here, but kind of starting with this, we have been in the camp for the last 2.5 years that you're not going to see inflation coming back down to that 2% target anytime soon. You're not going to see interest rates coming down. And, the big reason for this, and there's been this huge, I would say premature celebration in the markets that we've kind of achieved that. We're on our way down to that, right? The Fed started cutting rates. That's great. But, I think you have to caution yourself of just assuming that it is going to happen without this big hit to the labor market, to the economy as a whole. And if you look at the chart that we have up on the screen here right now, we're looking at a couple things. What this chart shows is that black line is inflation over time. Okay, we're plotting this back to the 1960s. Those green lines down the center, that shows every time the U.S. has entered a recession. And that dotted line, that dotted red line down the center, shows every time we've breached 5% inflation, okay, like we did this time. And what you'll notice is never before in history, okay, even if I took this chart back further, never before has there been a time where core inflation has breached 5% like we did this time, and a recessionary hit to the labor market not been the solution to getting us back down to that 2% target. Okay. And now everybody out there now is like, yes, we're going to get there. We're going to get there. The expectation is we get to 2% without having any level of pain to deal with. And I hope it happens. I really do. But we also have to put that into context, knowing that if it did, it would be a first.
Right.
It's never happened before. And I think the Trump administration is processing this in a pretty big way. And I think, just like we talk about tariffs potentially being at the wrong time, I think DOGE is at the exact right time to help us get inflation and interest rates down. Doesn't mean that you're not going to see a lot of short-term volatility and a lot of pain in the market. But at the end of the day, that pain is the medicine necessary to get us where we need to be long term. And I am of the mindset that Trump he is okay if we enter a recession. And honestly, the sooner the better. The sooner we have that play out, the easier it is to point back to, oh, this is the economy we inherited. And this is Biden data. You saw Lutnick, Commerce Secretary Lutnick, talking about this last week with some of the data coming out. Oh, this is bad data. Well, this is Biden data. Okay, so it's very easy to point back and say, if the sooner the better. And if you look at DOGE, I think why we're finally coming around to this idea that interest rates and inflation could be heading down. If we go to that previous slide, we've been propped up on this sugar high really over the last 4 years since the pandemic, 4 or 5 years since the pandemic. And inflation has really been moving right in lockstep with government spending. And what we're looking at here is, if you look at that green line shows the U.S. budget deficit as a percentage of GDP. Over the last 4 or 5 years, we've been running an average deficit of 6 to 7%. In an environment where almost everybody is employed, the economy is very strong. It's absolutely absurd. It's absurd. This is basically where we were throughout the depths of the global financial crisis. Okay, that's recessionary level spending that we have been seeing in an environment where you've had unemployment around 4%. And the problem with this is not only is pumping all that money into the system problematic, but also if we look at how good and strong this labor market actually is, you still have people's wages growing at 4.5%. That's nice that people are making more money, but it's also makes it very difficult to get down to a 2% inflation target. You just think about this logically, okay? You think about this logically. The more money people have, the more they're out there spending, the more that puts pressure on goods and services to move higher. The more that companies have to pay their employees. They don't want to take a hit on their margins. If they're paying their employees more, they want to raise their prices to offset that hit. Okay, so I think what you're seeing now, the overall estimates with DOGE, you're going to see about 300,000 to 500,000 federal employees lose their job, and with that, about 2 contractors per federal employee. So you're looking at about 1 million to 1.5 million federal jobs that are going to be cut. And the reason that we talk about this coming at a good time is we still have that labor market that is exceptionally strong, but it needs to soften. If we want to get inflation down, that labor market needs to soften. People need to stop being out there and spending so much money. We need to stop seeing companies have to increase their prices to pay people more. So it is, all of that labor will go into the private market. It'll be absorbed there. It'll soften that labor market and really help us get inflation and interest rates down. And again, I think Trump knows that. He's okay. He realizes that it's going to be some short-term pain with all those layoffs, But at the end of the day, what he wants those interest rates coming down so people can afford their houses, because ultimately that's going to be very important. And if we have a year or two of pretty high volatility, and then the last 2 years can be a big boom, all the better. So overall, we don't necessarily see that as a bad thing, and it needs to happen. It needs to happen to get inflation down. It's coming at the right time. You look at the market over the last couple of years, almost 25 to 28% of all jobs created were in the government sector. So really taking that pressure off, relieving some of that, I think will help the inflation situation. Yes, it's going to lead to some pain like we're seeing right now in the short term. The unemployment numbers probably aren't going to look very good. But at the end of the day, that helps us get inflation down. It also makes that that labor capital much more efficient to increase productivity long term. So overall, again, it's preparing for a wide range of outcomes. It could continue to position for short-term volatility, because again, this is a much different administration than you saw the first time around, and I think the name of the game is short-term pain for long-term gain.
Yeah, absolutely, Tim. And I think, on the timing note of all of this as well, I'm sure there is a lot of pressure from not just the Trump administration, but Republicans more broadly to make this happen quickly, knowing that recency bias is certainly an element of voter motivation in the midterms and in the next presidential election as well, with the economy being often the top reason why people vote the way that they vote. So with this in mind, knowing that there's a potential for upwards of 1 million people to potentially lose their jobs in potentially also the short term, I think that having a little bit more specific idea of how we can sort of brace for impact, whether you are impacted by these shifts in the labor market or not, is something that is of very much interest for people listening to this and watching this conversation. So let's talk a little bit more about the action element of all of this. Andrew, I would love to hear your perspective here on how something like a buffer ETF can come into play in people's investment strategies, knowing that there is going to be volatility expected in the near and medium terms of this administration and beyond. And it's also just a bit of a fact of life for anybody who is playing this game that volatility happens. Tell me a little bit more about how buffer ETFs are something to keep in mind. What are they? Who are they for? And why do they matter in a market reality like this, in an economic reality like this?
Yeah, thanks, Kinsey, for that great question. To Tim's comment, it really is about preparing for a wide range of outcomes. And so a buffer ETF, and there's variants of that, is a great way to position. So it's probably worth, like you said, backing up first and foremost and discussing the idea of a buffer and what that looks like in a portfolio and the purposes behind that before we get into exact ideas. We want to give folks kind of 3 ideas today, make it very actionable. But backing up to your first introductory comments, buffer ETFs is really all that Innovator does. We now, like you said, are about $24 billion in assets, only founded in 2018, but that's also 2017, but in 2018, we were the very first to market in this space. So it's something that it's our bread and butter, the pioneer in the space, and it's what we do, but it is constructing portfolios that provide that known downside protection with then a known upside cap. And just to make it clear, a buffer is a protection against initial losses in a portfolio, based upon a reference asset. And so if we are tracking, say, the S&P 500, you have a buffer of 15%. That just implies that if the S&P falls 14%, you're down 0. If the S&P falls 10%, you're down 0. If it falls, say, 20%, you're down the net difference being down that 5% in the case of a 15% buffer. So that's a very simplistic and helpful idea for folks to grab onto, to know that that known downside risk is taken care of. And yet there is a cost to that. The cost of that protection comes in the form of an upside cap. Now, most oftentimes you'll see a very healthy participatory cap of, say, 11, 12, 14, 15%, but you do have a hard cap to the upside. So on years when the S&P absolutely runs up, say, 25, 30%, you may be capped out. We find that trade to be extremely beneficial to clients to have that known downside protection for a still healthy upside cap. And that goes back to that behavioral finance idea of folks feel the pain of a loss 2 times as much as the pleasure of a gain. And you really want to avoid a portfolio drawdown if you can. So that's the concept of a buffer ETF. We utilize options in our ETFs to achieve that. Very straightforward, very simplistic. But again, we offer a variety of different buffer ETFs for the sake of protection. And so to your first point, where does it fit? It fits in about any portfolio, believe it or not. But we would say, especially in that pre-retiree or retiree stage, Or if you say are a young investor that has actually tilted some towards, say, a dividend play or some sort of low volatility, a slight protection there, a buffer might be a way to get even a bit more equity exposure while still having some downside protection in the portfolio. So again, that's the concept of a buffer. You can put protection in that realm. I do want to mention, Kinsey, quickly, there's also the concept of a floor, which will flip that. So the buffer is initial protection. A floor is actually where you take on the first amount of losses yourself. You're on the hook for that. You then put a floor beneath your loss, and you're safe beyond that. And so in the concept of, say, a stylized example of a 10% floor on a product, if the market falls 10%, you do experience a 10% loss. But if the market falls, say, 20, 30, 40, your max loss is that 10% floor. And that inherently has an appeal to clients as well, because oftentimes you'll have a higher upside in that scenario and be able to participate longer in the market on the up. So you have this concept of buffer and floor, both utilizing options, both in the vein of risk management that Innovator is so well known for. And so the portfolio fit really depends upon the client. We've kind of come into these three strategies here. So I don't know, Kinsey, if you have any additional comments here before we dive in. I don't want to take too much time going through exactly the numbers on the screen, but I'm happy to talk about each of these in turn if you'd like.
Yeah, totally. I mean, let's hear some highlights. I think this is interesting, especially when we're talking about the strategic plays, right? We're as investors always trying to kind of figure out, does this fit for me, and notably, when does it fit best? So I'd love to hear a little bit more. Yeah, let's walk through it together.
So at this point, if for those viewing this right now, I admit there's a lot of information on this slide. The goal here is to give you three high-level tickers. Innovator offers a lot of ETFs. In fact, in the ETF landscape across the world, there's now 4,000 tickers out there with 10 trillion in assets. So you can get lost pretty fast. We're giving you three actionable ideas to kind of fit three different risk buckets. And that's the goal here. So you can ignore the small text beneath the headers if you'd like, but it's about kind of three ideas to give you a different range of outcomes to Tim's comments originally. And taking it left to right, S-floor, SFLR as we refer to S-floor, is this maybe slightly more of a kind of an equity growth type idea, but still having a downside floor in place. That middle fund there, BALT, B-A-L-T, is what we might think of as a bond alternative or a defensive equity play. And then Z-MAR, that word defined protection there just implies that actually that's 100% buffer before fees and expenses over the outcome period. So again, S-floor, think of that as what I talked about, S for S&P or broad market exposure. The floor is kind of the concept I mentioned before of this floor idea. So you have there the bullet points beneath it where you get about 70 to 80% of the upside. Your target annual max loss is 8 to 12%. And you have, again, the opportunity to get a lot less volatility in the market. And so where we see this fund used by a lot of clients is actually more in their core equity type basket. It's not, say, in this separate sleeve for hedging or the separate sleeve for kind of safe assets, if you want to say that. It really is more of a core-like holding because of that ability to capture 70 to 80% of the upside. And that, again, goes back to, I think, we're entering March Madness season here in a bit for NCAA basketball. That defense wins championships. That's the concept here in the portfolio, is that if you are able to protect your downside and even mitigate some of that drawdown, your recovery, albeit it may not be a 100% recovery alongside the market, but you're going to recover actually faster and actually with a better outcome because you're digging out of a smaller hole. So that kind of concept to clients about playing a little bit of defense makes sense in their core-like equity basket. And that middle fund vault, I think fits nicely for folks that have any sort of fixed income allocation right now. So talking to clients that want to talk and say, hey, we want defense in our portfolio, but man, bonds have been challenged. Yeah, they've had a good start to 2025, but the last 3 years really challenging for us. Correlations have gone up. Performance has been down. How do I think about the bond allocation? BALT comes in as a way to tie some equity dollars to a kind of a safer outcome, meaning that you have this 20% buffer, not a floor, 20% buffer over a quarter. And so the change here is that you get a buffer against, again, the first 20%. So the S&P falls 15% in a quarter, you're down 0. And each quarter, that buffer resets for you. You get that fresh 20%. And so, again, the stat we throw out to clients, and there's a lot of stats I know that we're talking about, but the S&P has only ever had a quarterly loss of 20% or more 4 times in its history. So it's a very low probability of a quarterly loss of 20% or more. And when it has breached that 20% level, it's barely breached it. And so you have this ability to, in a sense, be flat in down markets. Ideally, that's the goal, no guarantee, and then participate a bit to the upside. So folks watching might say, what, that cap you've talked about, that 2.4% cap seems awful low. I don't want to settle for 2.4%. Well, that's just a quarterly cap. So each cap is dependent upon the outcome period. So 2.4% through March 31st. March 31st, it might be 2.3%, 2.5%. It resets to its dynamic number, but that's each quarter you get that. And then lastly, and I can pause for questions here, Kinsey or Tim can chime in, but ZMAR is this idea of taking simplicity to its highest level. It is 100% buffer on the downside before fees and expenses over a 1-year period. And that's, again, as straightforward as you can get. People ask, well, what's the catch? The catch is that you're tying this to the equity market. And so your upside is dependent upon the S&P rising, as opposed to say, well, I can get 4% in cash without doing a thing. Yeah, you can get 4% in cash. And if the market falls, yes, you're still getting your 4% in cash, but that's a pre-tax number. There's a drag on the portfolio in that sense. And inherently, the market tends to, over time, appreciate. Now, again, no guarantees, but whether it's 6 months, a year, 2 years, you tend to see the S&P rise. And so usually it's been on that magnitude of, call it 7, 8, 10, 12% over certain time periods. That's going to get you a possible higher return than cash while still giving you 100% protection on the downside. So again, as clients come to us and say, hey, we got cash on the sidelines, I'm still nervous. Tim's comments have scared me, all the DOGE talk, all the tariff talk, I don't know what to do with it. Well, let's step in with ZMAR. If you have somebody that says fixed income, it's been challenging for me, good start 25, but really I want to have more of a kind of a steady, stable state, maybe a bit more predictability, talk about ball. And then for the equity folks on the call, the younger clients, even for the pre-retirees, of course, S-floor is more your kind of evergreen, risk-managed, core equity-like holding. So again, I've talked for a while, but that's where I would direct folks for kind of 3 ideas that I think dovetail with Tim's comments earlier about the broad range of outcomes.
Yeah, and no, I think that especially that last one, 100% protection over years is incredibly important in this environment. You think about, the long-term returns of the S&P 500 being around 9%. To be able to look out there and say, hey, I'm going to get 7.77% if the market goes up, but know that all of this tariff, all of this, all of the negatives, the inflation, all of that stuff, we can put it to the side. It doesn't really matter. We're going to be fully protected from those losses, less the expense ratio of the strategy. I think it's incredibly important. Look at all of the gains that we've had over the last 5 years, locking those in, but still making sure that if Trump comes out tomorrow and pulls some tariffs off, we're going to capitalize on that rip higher, right? We're not pulling out altogether. We're still staying invested. Really, really important. And I think you could say the same thing for SFLR and Vault for that matter too. Really great strategies, but especially for everything going on, having 100% principal protection less the expense ratio of the strategy, I mean, is really attractive.
Yeah, absolutely. And I appreciate both of you, sharing a little bit more about when these make the most sense as kind of risk management strategies for investors. It brings to mind this idea a little bit of putting on your blinders in a volatile market like the one in which we are, right now. It's one of those investing adages that I think people hear a lot. Another one is that millionaires are made in recession. So I know we've had a lot of talk about recessions over the last several, weeks and months from some very high profile people, from, people on Twitter, really anywhere. I would love to hear your perspective though on that idea that this could be a time to lock in and to really take advantage of, circumstances that might be, to your point earlier in our conversation, Tim, a little bit of short-term pain for a little bit of a lot of bit of long-term gain. Tell me a little bit about what you're expecting for, just the kind of everyday retail investor who might be listening to this over the coming weeks and months. What's on your radar? Like what's something that you're anticipating could be the investing reality for these folks?
Well, I don't know if you're necessarily looking at a full-blown recession, and I think that has to go with the starting point of how strong this economy was coming in. And again, I think a lot of that has to do with just the sugar high that the government put us on over the last 8 years or so, with all the the spending, with things being so good. But we do have to prepare for that. And I'm noticing a lot of investors. I got a text from a family member just yesterday that was just freaking out. Oh my gosh, what is going on? Should I sell everything? It's like, well, we're down about 6%. That's really not much at all in the context of a typical pullback. So we want to be prepared, and I think it's also important to remember, even a recession, those are healthy for capitalistic societies, right? You need them from time to time. You need to shake out some of the inefficiencies that are in the market. And I think at the end of the day, if we do have that and are able to get prices under control, it's going to be a long-term win. So yes, there's discomfort. Stay the course, stay invested, and I think strategies like that ZMAR can really help you do that and still make sure you're not losing any sleep at night if we continue to see the trade escalate or whatever it is. So that's where we're at right now.
And Kinsey, I'll add just to dovetail Tim's comment quickly. The one of the positioning points that we talk a lot about is I think the market has almost doubled in the last 5 years. To your point, it's been, to Tim's comment, a sugar high. But if you say put a floor in now, and that S floor example we talked about, if you say put a floor beneath your gains, you're almost just call it the last 6 to 7 months at risk. So it's almost like this kind of behavioral finance way to say, hey, you've doubled your money in 5 years, put a floor beneath that in a sense with this S floor idea. Only put a little bit of that at risk, lock in those gains, and you can still ride it higher if you need to. Because again, it is a lot of unknowns, but that's a way to think about this floor concept of almost, hey, you've made the money, let's keep the money, but lock that in with a floor beneath it and continue to rise higher with good upside participation along the way.
Yeah, absolutely. I mean, there's a reason why it feels nice to have a little bit of an insurance policy, whether we're talking about investing or really anything in life. Uncertainty is a given. It's something that we can be certain about and something that we can come to expect. It's been really helpful for me during this conversation to get a little bit more specific perspective on what that uncertainty might look like, how it might unfold in the coming weeks and months. So I want to thank you both so much for your time. This has been really informative. And I have learned a ton. I'm sure that everybody watching this has as well. So Tim, Andrew, thank you so much for all of your thoughts and your perspective today.
Enjoyed it, Kinsey. Great
Thanks
to be
a lot,
with you.
Kinsey. It's great.
Yeah,
Thank you.
Of course. Thank you again. And thank you to everybody listening. I hope you enjoyed this conversation. Once again, I am Kinsey Grant Baker for Barchart, and I hope you have a wonderful rest of your Thursday.